What's up, everybody? All right, so welcome back. We're at episode number 2, still going strong here. Just me today. No guests for today, so it'll be a little bit quicker, a little shorter, more concise. Hopefully, get some great points across to you. Let me jump right into telling you what topics I wanted to cover today. I got some notes written down here. So I'm going to go over BOI reporting. So this is small business oriented. This is the beneficial ownership information reporting that everyone's pretty much either got spam mail about at this point or heard about from their friend or whoever. I get questions about this multiple times a day now, so I'm going to just go over what's going on with that right now. We got John Doe summonses for gig economy workers, which is something that's coming out of California right now, but that could impact everyone and anyone. We'll go over that. There's the Social Security Fairness Act. So I am recording this episode a few days prior to when it's going to come out because, I'm still getting used to this thing, but the episode is going to come out the day after we expect President Biden to sign this into effect. And I do believe that it's going to get signed. So we'll go over, either way, one way or another, whether it gets signed or sent back to the Senate. We'll go over what that means for you guys, for some of you, really. Then I just wanted to make some recommendations on just Social Security in general and staying on top of, your role in Social Security, what it means for you. Or Social Security's role in your life. And then we have, what else do we got here? I wanted to recap the standard versus itemized deduction discussion that I started last week with Kristen. Just go into a little bit more detail and how you should look at this, in my opinion at least, and how I look at it with my clients when we're going over this stuff. And then just a couple of things for a better tax outlook in 2025. Potentially. Maybe you're doing all the right things already. Maybe you're not. Maybe you just want your thoughts to be reinforced a little bit to feel better about them. So we'll go over that as well. Now, let's, I guess, jump right into it. BOI reporting, the beneficial ownership information. So this is a rule that was passed last year that basically said that any company, a small business formed prior to 2024 had to file this report by the end of 2024. Any company opened during 2024 would have 90 days to file, and then any company opened in 2025 and on would have 30 days to file. What the Financial Crimes Unit, FinCEN, wants from us basically is transparency on who owns what. Clearly, there's been a ton of financial crimes going on, tons of non-disclosure, people hiding assets offshore, I'm sure happens all the time. So, and I believe that this is what the government is trying to crack down on. We already have reporting on when you hold foreign financial assets. If you have over a certain amount of foreign financial assets and you live here or file a tax return here in the United States, you are required to report those assets to the United States as well. It doesn't mean that you have to pay a tax or anything, but there is reporting required for it. So same thing here. Now, in the beginning of December, what happened was a Texas federal district judge put an injunction on this requirement that has gone to be reviewed by the courts. And the injunction basically said that, we deemed this as unconstitutional. We want the courts to review this. Let's see what happens. And during that time that there was an injunction, that meant that you could still file the BOI report, but it wasn't mandatory. It was just voluntary. And what we were worried about at that time was that if the injunction failed, if it got taken back, if it got slammed, then what happens with that December or January 1st deadline that we had for all those companies prior to 2024, or that 90-day deadline for the companies open in 2024? Would we miss the deadline? Would we, get hit with the penalties for that? And so what ended up happening was that the injunction was lifted. And however, what was nice was that we got an extension for the filing deadline by the amount of days that the injunction was in place. So I believe that was 12 or 13 days. I think January 13th became the new deadline, where it was originally January 1st. Now, a couple days after that, probably, I think it was 5 days or so, that went back into appeals. So now it's in court again. And now BOI filing is voluntary again. My take on this is, if you have nothing to hide, and I don't think you should, and if you do, you've got bigger problems, just do the filing. Most people that I deal with are very small businesses anyways. It's maybe just the business owner, couple employees here and there. just do the filing. Especially as we head into tax season right now, if you're going to be searching from help for someone who is familiar with your business, it might become a little bit difficult to get that help quickly. Otherwise, if you do have something to hide, or if you're just completely against this, like many people are, wait, the best thing to do, fincen.gov/BOI. It's going to be right on there, live. What's happening? Is there an injunction? Is there not an injunction? What are the due dates? There's a very extensive FAQ, frequently asked questions page. You go to that page, you hit Control F, you search for what you're looking for. Do I have to file if I'm an LLC? Do I have to file if I'm a corporation? Do I have to file if I'm a partnership? Do I have to file if my business closed this year? Do I have to file, my business opened this year? And so on and so forth. I promise you, it's all there. It's not incredibly difficult to do. However, people like myself, attorneys, whoever you turn to, there's filing services out there. If you have a small business, you already know this because you've gotten tons of mail about it. There are people out there to help you if you want that peace of mind or a second opinion on it. I mean, that's kind of it for BOI reporting. Again, don't get, in my opinion, don't get crazy with it. This is something that I think is very important. John Doe summonses. John Doe summonses, basically the way they work is that a state or federal court will say, hey, we're going to go to a particular company that we believe has been paying money to people who should be reporting that money as income on their tax returns, but might not be because the company paying them is not required to file 1099 forms or W-2 forms or whatever the form of income they were paying was under what reporting it falls under, right? So the government will serve a John Doe summons on this company. The reason they do this is because they can't ask the company directly, like, hey, we're looking for just this person who probably made just this amount of money, because realistically, the government doesn't know. But what they could do is say, hey, from the periods of 2018 through 2020, for all the people who provided services on your platform, we want information on all of them. Now, this happened recently, I want to say about 2 or 3 years ago with Coinbase, right, for cryptocurrency exchanges. Nobody was reporting crypto. Barely anybody still is. And so the government just said, hey, John Doe summons. We want people who traded on your platform from X year to Y year and who did this amount of volume in trades. So let's call it, $10,000 to $100,000 in trades. Realistically, it was a much higher number. And then the company is required to send back a report with all the people who performed on that platform and all the information that this company has pertaining to them. So now in this case, what I wanted to talk about today, what happened is there was a John Doe summons by a California court to a company called Just Answer LLC. And they wanted information on people who provided services on their platform from 2017 through 2020. So Just Answer LLC is a platform where you can go on, make an account, and seek advice from professionals, which might be doctors, lawyers, accountants, you name electricians, plumbers, you name it. As a professional, you can sign on there and get paid for answering a quick question or getting on a quick call or whatever. And not under all circumstances are these professionals receiving income reporting documents like a 1099 form, for example. The IRS believes, and California clearly believes, and they're probably right, that many of these people who performed services on the platform did not report their income throughout those years and therefore did not pay income taxes on that income. A very, very common misconception is that if you earn under $600 on a 1099 agreement, on an independent contractor agreement, you are not required to report that income. Not true. It's a myth. The truth is, if you pay somebody for independent contractor services and you pay them less than $600 throughout the year, you, as the person who paid, the payer, are not required to issue a 1099 form to that person. However, that person, the payee, the person who earned that money, the contractor, they're required to report income whether they made $1 or $100,000. Doesn't matter. And so, in a lot of cases, people are just evading. In many other cases, people just don't know any better, or they were given false information. So what you need to know is that no matter where you make your money from, no matter how you earn it, whether it's legal or illegal, the IRS expects you and the states expect you to report every dollar of income you made. The only circumstance really in which you would not have to report that income, or which you can make an argument for not showing that income on your tax return, is if it's a hobby. It's something that you're not doing for profit. Maybe you have a garage sale here and there, just, spring cleaning, empty your stuff out. It could be a hobby. Maybe you make, you do pottery, for fun on the weekends, and you sell a couple of pots here and there, and, kind of your expenses for this more or less offset, but you're clearly not doing it for a profit. It's a hobby. You don't have to report that. Everything else you do. The people like an accountant like myself who are on that platform providing answers for money are clearly providing a service for profit to receive income. They should be reporting that. So the fact of the matter here is, and the takeaway is, always report your income. The government does have ways of figuring you out. And again, this is something that people maybe would expect to happen. It's regular work. People have been doing independent contractor work forever. What happened a few years ago with Coinbase, with crypto, people were on their high horse. They were like, oh, blockchain, you can't trace me, come find me, come, try me. And they did. And they did find people. And they'll do it when you least expect it. And they'll wait. And one of the reasons that they wait is because they're waiting for interest to accrue, penalties to accrue. Like I said, this story about the California thing just came out. It just came out. I don't know if it was a few days ago or a week ago. They're requesting information for 2017 through 2020. That's 4+ years, 5+ years of accrued interest and penalties that you almost definitely will not get out of, especially not in a state like California or New York or Connecticut. These are hardcore states when it comes to getting their taxpayer money. They have very high expenses. They want every dollar that's coming to them, as of course does the IRS. And by the way, keep this in mind. I might as well mention this. If the IRS ever catches you on something that you misreported or underreported or just did not report, neglected to any type of income, the states find out about it too. So keep this in mind as well. If the IRS ever sends you a notice like, hey, your information doesn't match ours, you underreported this income, or you missed reporting this form on your tax return, and you live in a state that has an income tax, make sure you go and amend that state return too as well before the state catches you. They will have much more leniency that way, and vice versa. If the state gets you on something, whether it was harmless or harmful by you, make sure you go and amend that IRS return before they get you first as well. And remember, people always also have this misconception that, 7 years passed, 3 years passed, they can't get me, the statute of limitations is done. If they determine that this is fraudulent or negligent, grossly negligent, they can go back as far as they want to and get that tax money from you. So do the right thing. I believe that's all I wanted to say there. Next was the Social Security Fairness Act. So this doesn't apply to too many people in the grand scheme of things, but I know that a lot of those who follow me might fall into this category. So workers who work for federal, state, local government oftentimes are under a contract where they're not required to pay Social Security taxes with their paychecks. However, they pay into a pension fund instead. And so upon retirement, they're not really entitled to much Social Security benefits because they're getting this pension. The way that those workers can get themselves some Social Security benefits is by working a second job or doing their, 20, 25-year tenure for the federal, state, or local government, and then working full-time for another place where the income is Social Security eligible. The problem oftentimes, and people don't realize this until it's too late, is that if you do have a job in which you earn a pension and you go and work that second job or third job or fourth job to pay into Social Security to ultimately get Social Security benefits that you can rely on in retirement, your Social Security benefits get reduced because of certain acts that were passed in the past, which are called the windfall elimination provision and the government pension offset. And so essentially, I believe it's up to 50% of your Social Security benefit could get cut if you did not do 30 plus years of substantial earning work in a Social Security eligible climate. And substantial earning work, just to put that into more understandable terms, for 2024, I believe you had to have made at least $31,500 during the year to be considered substantial. If you do put in those 30 years, you can get your full pension and your full Social Security benefits. And just to put it in perspective, most people, Social Security benefits who have done, 10 plus years of working a Social Security eligible job, and have paid in and made a relatively significant salary, they're looking at probably $1,900 to $2,100 a month in Social Security benefits. If you fall into this small category of people, instead of $1,900, you're getting like $1,300. For most Americans, that's a huge freaking deal. That's a difference between making rent, making the car payment, putting food on the table. Who knows how many, family members you have to feed, whether it's kids or grandkids, etc. So it's something to keep in mind. Now, the Social Security Fairness Act is supposed to repeal those two sections, right? So the House passed it, the Senate passed it, and hopefully, once this comes out yesterday, President Biden has signed it in as well. He is definitely expected to do so. Once this happens, again, it repeals those two. And so now all of your Social Security contributions will fully count towards your retirement benefit. Here's the thing for me. I'm relatively young, right? I'm in my 30s. I don't necessarily believe without substantial change that Social Security is going to be available for my generation. I don't personally care too much about this in that sense for myself or for my future kids. I do care about it for my parents. I do care about it for my grandparents and anybody their age. So if you're somebody who's already in retirement or soon approaching retirement, I would say, in the next 15 to 20 years, I think this is something you should care about. And again, specifically for those who work for these federal, state, local agencies. So that's, teachers, police officers, firefighters, EMTs. It could be people who work for state hospitals. And so this would apply to doctors and nurses and, dentists, optometrists, PAs, you name it. It'll apply to all of you. And then federal workers as well, of course. Now, what this also means for you, and something that people tend to miss, is most people have the misconception that no matter what financial position you're in, Social Security income is not taxable to you in retirement. And that's false. So what you need to keep in mind is that if you make over a certain amount of money, your Social Security can and likely will become taxable. Up to 85% of your Social Security income could become taxable. And again, if you're not well prepared for this, that could be the difference between making rent, between putting food on the table, between paying that car payment, or hospital bills, deductibles, etc. So this is something to keep in mind. And one of the things I'm getting at, and I'm going to probably mention this a few more times today, is always review your tax and financial situation with somebody. It is very important. If you're savvy enough to do it yourself, by all means, that's on you. If you're not, talk to somebody at least once a year as you become a higher income earner, 2, 3, 4 times a year, if not every month. It's really important. The amount of horror stories that happen during tax season is sad and sickening sometimes. And unfortunately, the people that do get blamed are either people like myself, because you just have nobody else to point the finger at. The IRS is too far away, or obviously you or your spouse or somebody who just did not pay attention because they just didn't know to do so until you learn that lesson. And then there's those people who need to learn that lesson like 10 times before it actually hits them. So again, make sure you're reviewing your situation. Many people, they go into partial retirement. They keep a part-time job, but they already start collecting Social Security checks. They still have to pay, they don't have a secondary insurance to their Medicare. So they have still deductibles and that 20% co-insurance to pay. I promise you that if you're not in retirement yet, ask your parents. They know about this. They've been dealing with it. So very important. And then just since we're on the topic of Social Security, I think this is important because I've run into some poor situations with this as well with my clients and even relatives. You can go to ssa.gov, the Social Security Administration, ssa.gov, make an account there, and you could see your history of what's been reported to Social Security by your employers in the past, whether you're self-employed or you work for somebody else. It's important to review this, again, especially as you get closer to retirement age, I would say within 10 to 15 years of your expected retirement age when you want to start collecting Social Security for a couple of reasons. One is to make sure you know what your Social Security benefit should be at that point, which will help your financial planning for retirement. If you work with a financial advisor, hopefully they've said this to you before and probably several times. So you will see a chart that says, hey, you're on this trajectory. If you keep on paying this much into Social Security and you retire at 62, early retirement, this is how much your check should be. If you retire at 67 rather, this is what your check will be. If you want to stretch out a little bit, do late retirement, 70 years old, this is how much your monthly check should be. So, and that's something important to keep in mind. Now, on the flip side of it, there can be instances where you worked for some scheming employer or your employer went out of business in the middle of the year and they did not do the proper reporting to the IRS and the Social Security Administration. So the IRS and your state never received your W-2 information from the employer. So when you file your tax return, the stuff is not going to match. And this is especially horrible for those people who overpay their taxes throughout the year and expect a refund with their tax return. And then they have to wait 6 months, a year plus to get that tax refund back because they have to somehow prove to the IRS or the state that, yes, they did work for this person. Yes, these withholdings were taken from their paychecks. Because the government agencies otherwise have no other information on it because the employer never reported it. And the other thing is that if Social Security doesn't receive the information, that means your benefit check when you're in retirement is getting clipped by however much for however many years this went on for. So I would say that at least once a year, it's good to get in there, take a look, make sure things add up, make sure where you need to be. Maybe, you expect a certain income during retirement and you're kind of approaching retirement now and you're not quite there where you wanted that income to be. And it's going to make a decision to hustle a little bit extra for a little bit longer, second job, etc. Ask your employer for a raise, whatever it might be, pick up a side hustle, open up a business. Maybe that's what you need to do. So, but it's good to be in the loop and it's easy to be in the loop, especially in this day and age where even if you're not computer savvy, I think it's like a 95% chance that somebody that is. And if not, just call them and find out. If you're not computer savvy today, you likely have the time to make that call and sit on hold anyway. And that's not to insult anybody. It's just how it is. So I did have a few clients that this happened to. One in particular, they worked for an employer who was just super shady. I don't want to give away any details to not, kind of give away their identity, but they worked for an employer for several years. They got their paychecks. Their paychecks were net of their withholdings, meaning everything was correct on there. It showed federal withholding, state withholding, Social Security, Medicare, New York paid family leave, New York short-term disability. All the withholdings were there. They were a few years behind on their tax filings for other reasons. And when we finally went to file their tax returns, all the returns got rejected. None of the refunds came in. This person was years away, like 3 or 4 years away from their anticipated retirement to collect that Social Security check. Social Security had no information on them. Never. They didn't have a single year of income on record. And this is a lot of work to prove to the IRS and the state and the Social Security Administration that these things, what actually transpired. And sometimes it involves getting attorneys involved. And very often, the people who end up in these situations can't afford to do all of that. So they're really stuck. So again, you screwed up 1 year, fine. You got screwed for 1 year. You'll fight for that for a little while. Better than getting screwed for 3 or 4 years. Excuse me. That'll really hurt you. So that's that for Social Security. Now, the other thing I wanted to talk about was standard versus itemized deductions. It's really important, especially in today's landscape, since the Tax Cuts and Jobs Act, back when Trump took office, and in 2017, and especially now with President-elect Donald Trump. I personally, and again, this is just a feeling, who knows what's really going to happen. I feel like a lot of these tax laws are going to stay in place. They were set to sunset at the end of this year, 2025. But now that specifically he is president again, even if it was another Republican candidate who got elected, I feel like we would have seen some big changes. With Donald Trump being elected, I feel like we're going to see an extension and hopefully, continued improvement of our tax laws to try and help everybody. The big thing that happened back then that was a major change for a lot of people was the distinction between the standard and the itemized deduction. So just to recap what this is, anybody who files a tax return as a resident of the United States, whether you're a citizen or not, is allowed a standard deduction. What the standard deduction does is, after we've aggregated all of your income, your losses from business, your interest income from banks, your dividends from stock holdings, your capital gains or losses, if you sold a house, the income from there, so on and so forth. Once we aggregate and consolidate that figure, the standard deduction reduces that figure before we determine how much tax you should have paid throughout the year. Once we determine how much tax you should have paid throughout the year, we apply any tax credits you might have, like the child tax credit, or the solar credit, and a bunch of others. Once we apply those credits directly against the tax you should have paid throughout the year, we apply the amount of tax you actually paid throughout the year, whether through withholdings at work or estimated tax payments, or a rollover of an overpayment from a prior tax year. And the remaining amount is either what you're due as a refund this year from the government or what you still owe them. The standard deduction in 2024 was $14,600 for a single filer. Double that, $29,200 for married filers. Now in 2025, and so the 2024 amount, just to be clear, that's what you're going to see on your tax return when you file this spring. For 2025, the amount goes up. The amount almost always goes up for inflation, to index for inflation. It's going to be $15,000 for the single filer and double that for the married filer at $30,000. And then those who are over the age of 65 and or legally blind would get a little bit extra, $1,500 for each of those things. It's significant. It's a significant amount. Now think about it. If you're a single filer and you're a very low income earner, usually like a student, or usually a student, really, honestly, or somebody maybe who just came to the country a couple months ago and they only worked for a couple months, or somebody who was laid off, unfortunately, for a majority of the year and then just worked a little bit. Your income might very well be under $15,000, or your income is a little bit over that, but with that $15K deduction and some tax credits you might qualify for, you might have no tax liability at all. Same with married filers. Maybe one person does make that $30,000 a year, but the spouse doesn't work. They stay home to help take care of the kids, while the $30,000 plus some other tax credits and government assistance helps pay for the food and shelter for the family, right? This definitely happens in America, for sure. The itemized deduction is something you are given the opportunity, the option to take if it makes sense for you. You can't take both. You can only take either the standard or itemized. The itemized deduction consists of several things. It's also something that changed with the same Tax Cuts and Jobs Act. But currently, what it is medical expenses. The medical expenses have to, and it's by the way, it's going to be a combination of the next few things. Medical expenses, only the portion that exceeds 10% of your gross income, only the portion that exceeds that amount is counted towards your itemized deductions. And there are many medical expenses that might qualify. There are some that are kind of questionable and debatable. I even had a question today about it. If I have a certain diet that I have to follow, does the prescribed food for that diet count as a medical deduction? So that I'll explain that in a second. So, I mean, we're talking doctor's visits, we're talking prescription eyewear, we're talking, dental work that you had to get done, your deductibles, your co-pays, and then things like this. So a prescribed gym membership, maybe you're undergoing physical therapy treatment, occupational therapy treatment, and they're requiring that you go and have equipment to work with. And that's going to be whether you get a gym membership or you buy equipment for the house, as long as it is very specific, you have a prescription for it specifically for that, for your medical treatment, that would add into those medical expenses with the dietary stuff. And just because this, coincidentally came up today, I'm going to mention it. You can deduct the food you have to purchase for that specific diet. However, and this usually comes up, with people who must undergo weight loss to live, or people who are allergic to certain foods, can't eat certain foods, get sick from certain foods, like very, very ill every single time. Only the portion of the expense for the food that exceeds the expense of the normal version of that food. So let's think about, like gluten included versus gluten-free food. Only the portion that exceeds is going to be counted towards it. Is it worth it really for most of us to sit down and count that up? I'm not doing that shit for you. I can promise you that. And you're probably not doing it yourself either, unless you really got nothing else better to do, or you're that super neurotic person that's going to spend the time on it. So again, medical expenses, including all those things, the portion that exceeds 10% of your gross income counts towards your itemized deductions. The next thing is a combination of your state and local income taxes and the property taxes on your primary and or secondary residence, capped at $10,000. So the combination of those things capped at 10K adds to the medical expenses. Then you have your mortgage interest paid. Only the interest on the first $750,000 of your loan on your primary or secondary residence, or on a home equity loan that you received, that where the money was used for the improvement of that home that secured the loan, that portion of interest adds onto the itemized deductions. And then charitable contributions are going to add on as well. And for the purposes of what I'm talking about, I'm not talking about state related itemized deductions. I'm talking about federal related itemized deductions. If the combination of those things adds up to more than the standard deduction, so 15K if you're single, 30K if you're married filing jointly, and then there's a head of the household and, qualified widower as well. If the itemized deduction amount exceeds, we use it. It doesn't add on to your standard deduction and make it that much better, put it on steroids, it just replaces it. I swear to you this happens. There's a single filer who would qualify for a $15,000 standard deduction who will have $17,000 in itemized deductions. And yeah, we'll use that, but they think they're going to save thousands in taxes because of it. No, you might save hundreds. If you're in a higher income tax bracket, you'll likely save very little. It's important to keep that in mind. And let me kind of bring this all in and put it into perspective. We're in an expensive housing market and mortgage market right now, right? So it's tough for most people to buy a home. Many people are going to try and justify the purchase of that home with a mortgage by counting up how much in itemized deductions they will have at least upfront the first 5 to 10 years of having that heavy, expensive mortgage and maybe expensive property taxes. In saying that, hey, well, because of this mortgage and these property taxes, and I'm going to have itemized deductions now instead of standard deduction, I'm going to save X amount of dollars per year. They'll prorate it for the month and say, well, my mortgage is going to cost me this much less. Effectively, that's correct. You've got to be careful in that the itemized deductions replace the standard deduction. So and I had these numbers pulled up actually. Let me tell you. On a $600,000 home with a 20% down payment, meaning that you're taking a $480,000 loan at 6.75% interest, which I think today is actually kind of low for the interest, probably more around the 7% range. In your first year, you'll have $30,000 of mortgage interest that you're paying. All of it is deductible. All of it qualifies. The loan is below $750,000. So I would say like in the first, 5 to 10 years, $30K is roughly going to be your annual interest deduction. Let's say your property taxes on a home like that are, on average, what, $4,000 to $5,000? So let's call it 35,000 as your itemized deductions. It sounds like a lot, but if you're a married couple that gets a $30,000 standard deduction, this doesn't do much for you. Don't use this to justify that home purchase. Not saying you shouldn't purchase the home. You might still be able to afford it, and it could still make sense. Otherwise, you're, maybe in a market that you think is going to boom over time, or it's going to rebound from what we've been seeing the last few years. You're going to refinance the home in a few years, hopefully. There's definitely all of these justifications. Don't let itemized deductions be that one in that scenario. If you buy a home that you're buying for double that amount, maybe you're buying $1 million home, and your expected deductible mortgage interest throughout the year is going to be $60,000 plus $10,000 of property taxes. Maybe also a second home that you own, a vacation home where you have some mortgage interest to pay there as well. That would be able to add on to this. Now we're talking. Now we're talking about thousands of dollars in potential tax savings. That is very much worth having that conversation about and playing that into your strategy. I think that's like really what I wanted to get at with this. And I'm pretty satisfied with how much I've said about it. By the way, before 2017, when this went into effect, or before, I'm sorry, I think it was 2018. Before 2018, when this went into effect, roughly 30% of taxpayers itemized their deductions. The standard deduction was like a third of what it became, or a half of what it became, rather. Now, it's about 10% of filers. That's a third. That's a huge difference. So that just to put that, a little bit further into perspective. Now, a couple things I wanted to mention just for a better tax outlook in 2025. Many of the clients I've dealt with at this point, and if you guys are listening, I mean, we're doing tax withholding checkups 3-4 times a year, sometimes more, especially with how the tax withholding tables, not the tax brackets, but the tax withholding tables that employers are required, or payroll processors are required to use when they're running your payroll and getting you that paycheck cut. And this especially happens with people who are hourly earners, bonus or commission earners, or multiple jobs in the homes. Your withholdings are all out of whack. You end up either getting a $10,000 or $20,000 or $30,000 tax refund. I promise I'm not making those numbers up. That happens. Or you're on the opposite side of things. You're owing that much or more at the end of the year. Neither one are a good situation. Most of the time, if you owe $10,000, $20,000, $30,000, 9 out of 10 times, you also owe a penalty with it for underpayment of estimated tax throughout the year. If you're getting a $10,000 or $20,000 or $30,000 refund, think of the opportunity cost on that money. The IRS holds on to it, the government and your state, I guess, if your state has an income tax, they hold on to that money throughout the year, and they just hand it back to you in February, March, or April, or later if you're a late filer. No interest, nothing. Whereas especially these last few years where high yield savings accounts, the safest thing you can put your money into without risking it really. Um, More or less, this is not financial advice. This is my opinion. Think about the interest you could have earned on that money throughout the year. Even if it's $500 or $1,000, it is better than nothing. That'll pay for your next iPhone, you know? Could pay for a trip, could pay for a weekend getaway, a little Airbnb action. Keep that in mind. And so what happens with my clients is we go into this ongoing thing where we're constantly doing the tax withholding checkups. So I'll take your last couple of pay stubs from you, your spouse, however many there are, however many pay stubs there are, not however many spouses, and whatever interest income you have throughout the year, dividend income you have throughout the year, your realized capital gains so far, or any outlook that you have for realized capital gains, your business income, how many dependents you have, how many qualify for the child tax credit, how many don't, etc. You get my point. We add that all up, say it's April, and I'll tell you, like, hey, based on what's happened between January and April, I'm gauging what we believe will be the end result at the end of the year in terms of your income and your withholdings through work, and you're looking good. Or you're not looking quite right. Let's make some adjustments. More often than not, we catch these things, unfortunately, and to all of you that this has happened with, I'm very sorry on my behalf and everybody else's. It'll happen in November or October. And the issue there is that if I adjust your paycheck or help you get your paycheck withholdings adjusted in October or November, there's only a couple paychecks left in the year. So that shift in take-home pay could really hurt. Even if you don't need that money, like you have savings and you're good, even if you don't need that money, psychologically, it's a huge burden. Whereas, if we're doing that in March or April, let's just call it when we're doing your tax return, gives you way more leeway. There's way more paychecks to break down that deficit on, or vice versa. Maybe they're taking out too much and we can really, pump your paychecks up throughout the year and make you a little bit more comfortable day to day. So that's how it's keep important. So my point here is tax withholding checkups, especially if you're someone who was in that situation where in September, October, November, you had to make a drastic change with your pay stubs. Keep in mind, part of that drastic change is to make up for the beginning of the year. So now in January or February, you might want to tweak those again just to level things out. The next thing I had here was to review your retirement contributions and Roth conversions. And that's not necessarily something that you have to do in the beginning of the year. That's throughout the year and by the end of the year. You might be in a year, again, it's unfortunate, and if this happens to you, I'm sorry, but maybe you're in a situation where you had to take a leave of absence from work. Maybe you had significantly decreased pay. You had to take another job. You had to move somewhere for family or whatever. Maybe you lost your job. Unfortunately, there have been plenty of layoffs lately. If you're in a lower income year, that might be a good time to have conversions done from your traditional retirement account, the pre-tax account, into your Roth, your post-tax account, and take advantage of things there. I'm not going to spend too much time on that and jump into it, but if you have questions about that, reach out to me, or even better, reach out to your tax preparer and financial advisor on that. If you don't have a financial advisor, at least reach out to the brokerage firm that holds your retirement plans. They usually have people that can give you some advice as well. That's something to look out for. Now, with retirement contributions, it's kind of tricky, right? And again, this is not going to be financial advice. Some of this is my opinion. For those of us who are younger, keep in mind, retirement contributions are amazing. They could save you a ton of tax money today. If you're a high wage earner, if you're in those, 30+% tax brackets, every $1,000 that you're contributing to your pre-tax retirement plan is saving you $300 in taxes. If you contribute $10,000, that's $3,000 in tax savings, and so on. And the limits for 2025 at least are as high as $70K if you do things the right way, if you play your cards right, and if you have the income, of course, to do that. So something to keep in mind. Now, my thing is always don't put all your eggs in one basket. You're putting money into that retirement plan. Yes, it could be helping you out today if it's a traditional plan. You're also locking your money up for quite a bit of time, the next 20, 30 years. Again, if you're like around my age, possibly longer than that, depending on, what rule changes there will be in the future. And that's the other thing. How the hell do we know what the tax brackets are going to be in 20 or 30 years? What the, minimum age to start withdrawing from your retirement plan without any penalties is going to be, and so on. This thing is great. Make sure you're not putting all your eggs in one basket. If you might need money for some, if you're saving up for a house, or there are certain medical conditions that run in your family, just make sure you're prepared for these things as well. Here's what retirement contributions can do for you also, though. So those of you who have run into this before really feel it. As you start to make a bit more money, and I'm not talking about hundreds of thousands of dollars, I'm talking about sometimes even just $85,000, $90,000. There are limits put in place on you on your tax credits and deductions. Some of them, for example, education tax credits. Single filer, after $90,000 in gross income, you can no longer take that. You can no longer receive either the credit or the deduction, whichever one you qualify for. Married couples, it's $180,000 for those education credits. Student loan interest. Let's talk about all of this, student loan burden, trying to help them out, trying to forgive student loans, etc. But the student loan interest deduction is such a small cap to begin with. I mean, if you have friends who have gone to law school, medical school, dentistry, optometry, just graduate school in general is super expensive everywhere. The current cap, if you don't make too much money and you can deduct student loan interest, the student loan interest you can deduct is $2,500. Now, the income cap on deducting student loan interest is about $90K, slightly less than $90K. Meaning if you make over 90, you can't deduct your student loan interest at all. If you do make under 90, you can deduct up to $2,500 in student loan interest. But when you make under 90, you're in a pretty low tax bracket to begin with. So that deduction barely even does anything for you as well. On that $2,500, maybe you're saving, $250, maybe $300 on your tax bill. It's not big. And remember, it's not a credit; it's a deduction. That's my rant on student loan interest. But and there are other credits for it. The child tax credit is one of them as well. If you make over 200K as a single filer, 400 is married, on child tax credit, majority of it goes away for you, and so on. So in certain situations, if we can do some very good, meticulous tax planning, we can use retirement contributions, pre-tax retirement contributions, to bring down that adjusted gross income and potentially qualify you for some of those credits. It's very important to plan carefully, logically, and throughout the year, constantly. Very important to do that. Just to wrap up on this, one other thing to keep in mind, and this can affect a lot of households, and I've seen it do that before, children who are aging out of the child tax credit. So once your child turns 18, at any point throughout the year, they are not eligible for the child tax credit. So for the purposes of this tax filing season, if your kid turned 18 on December 30th, they're not going to be eligible for the full child tax credit anymore. They're going to be eligible for the other dependent credit if they meet all the other criteria. And that could be a difference between getting $2,000 and $500. So that can make a big impact, especially, if it's for multiple kids or whatever, on your tax return. And there could be situations where the 18-year-old who qualified for 500 has left the house and is now working, and the 17-year-old that has now become the 18-year-old, and you're losing about $2,000 in tax credit. So again, keep that in mind, please. And then one other thing is, and it's for a couple of reasons, I also mentioned this last week. Even if you do not have a filing requirement, ask somebody. Meaning, if you made under $15,000 for the year as a single filer on a W-2, you're not required to file, right? Like that's all you had. You're not required to file. You may still want to file, generally for two reasons. One of the reasons is if you don't have a filing requirement, but you had tax withholdings, income tax withholdings specifically on your paychecks throughout the year, either federal, state, or both, you want to get those back as a refund. But not having a filing requirement means is that your tax due throughout the year ended up being zero because of deductions. And so if you did end up paying any taxes throughout the year with your paycheck, you're going to get those back. The other thing is maybe you qualify for tax credits. If you're a very low income earner and you contribute to a retirement plan, even if it's your own just traditional IRA, not through the workplace, there's something called a saver's credit. You might get a couple $100 in a tax credit on top of getting those withholdings back. So keep that in mind as well. Maybe you qualify based on your age and circumstance for the earned income tax credit. There's a lot of people out there who leave money on the table, and you've paid taxes at some point. You will pay taxes at some point. Keep whatever you can in your pocket today. It's better than in my hands than in their hands. That's how I'm looking at it personally. And I'm sure at least the majority of you will agree with me. And with that being said, I think that's pretty much it. Just to sum up, we talked about the BOI reporting, the John Doe summonses. Very important John Doe summonses is just a lesson to do the right thing always. They might come for a John Doe on Airbnb, VRBO, various other Fiverr, you name it. There's so many out there. The Social Security Fairness Act, point being, it's going to make things better, not worse. For most people, the only thing it could make worse is that it shortens our runway for the amount of Social Security funds that are going to be left. The estimate is that it's going to shorten our runway by about 6 months. And 6 months in the grand scheme of time is not that crazy. But when you're the person that's going to end up missing out on Social Security, like, my generation, you're going to be a little bit upset about that. We talked about going on SSA.gov, making an account every year, checking, making sure things are being reported properly. Nobody's messing up. Nobody's scheming out there. The standard versus itemized deduction recap we did. And then, these nuggets for a better tax outlook in 2025. And listen, the things I listed isn't nearly everything that's out there. I'll try to give you guys a little bit every week, but make sure you do your research, talk to somebody. TikTok is not research. Instagram is not research. YouTube is not research. It's gathering information to then go and ask someone. And with that, that's it. And I'll see you guys soon.